Welcome to Counterpoint. I'm David Clement, guest hosting for Tanya Granick-Allen. The Bank of Canada has once again raised interest rates, now sitting at 2.5%. And while the rate hikes are seen as necessary to tackle inflation, which is expected to surpass 8%, there are a lot of looming questions about what impact these rate hikes will have. How will this impact homeowners, especially those on variable rate mortgages? Will increasing rates slow business investment? Or even worse, spark a recession? And how does this impact government debt? Joining me to discuss this is Ted Mallett, Director of Economic Forecasting for the Conference Board of Canada. Ted, thank you very much for joining us on Counterpoint.
It's a pleasure. Thank you.
So I want to rewind first here, going back to July 15th, 2020, to a quote from the Bank of Canada Governor Ted Mallett. He said, whether you're looking to get a mortgage, a major purchase, invest in a business, you can be confident that rates will stay low for a very long time. Obviously, a lot has changed between then and now, almost 2 years to the date. How did we get here?
Well, certainly the pandemic has orchestrated the kinds of changes that we're seeing, and the recovery, especially in the U.S., where consumer demand came back with a vengeance. The fact that people were buying goods beyond the capability of the distribution system to play up on that. So, of course, it pushed inflation high, especially on goods, even before we could see kind of a recovery in the services side of the economy. So, 2 years is a fairly long time. There's a lot we did not know back in July of 2020. Vaccines were not really on the horizon at that point. How the effect of the virus, although there was theoretical notions of transmissibility, extra variants, and so on, we didn't know that we'd be into wave number 7 on these kinds of things, nor how the economy would be performing. So really, Ted Mallett was trying to assure people in the economy that they would do everything they could to make sure that the best decisions at the time could be made with respect to borrowing, lending, purchasing, and so on. So there's a fair bit they did not know about how the next 2 years would unfold, and now we know.
Yeah, it's a good point. Although 2 years can feel like a short period of time, a lot has certainly changed in those 2 years. You raised some very good points there. One of the big aspects of the economy that obviously rate hikes are impacting is housing. We saw how home prices skyrocket over the last 2-3 years. How hard is this going to hit those who have maybe recently purchased a home or on variable rate mortgages?
It is going to be an adjustment for them. Even going back to July of 2020, the expectation of CMHC and many others were that we would be seeing a decline in house prices, because of concern about the economy, and recessions normally follow or associated with declines in home prices. What people didn't really fully take in was that there was just a massive nesting instinct. Homeowners or householders could not spend money on restaurants, travel, and so on, and they needed to, develop their own houses. They wanted to move to areas that they perceived were safer from the virus. If they were working from home, they wanted to be able to, perhaps renovate so they have some office space. If they had to move to, a bigger location, their children are home more often, they needed to adjust. And that sent the demand for housing, particularly in some of the suburban areas or farther afield areas, into levels that no one really expected that to take place. So there is a bit of definitely a whipsaw effect where people have, they've locked into bigger homes, more expensive homes because of the demand was there, and now suddenly they're potentially faced with very large interest rate increases. Now, we should also take a look that the rate increases themselves, we're only into should I say, the bank rate at 2.5%, which historically has been quite a bit higher than that in the past. So we're dealing with a very large change at a particular point in time, 1% last week. We may see some more, but we're still nowhere near the kinds of rates that the economy had seen back in the 90s and earlier than that.
Yeah, that's a very good point. Still below historical trends. We'll have more on this when we return from commercial. And we're back on Counterpoint, talking all things interest rates with Ted Mallett from the Conference Board of Canada. Before the break, Ted, you were talking about the impact this has on homeowners, specifically that 2.5% is actually still historically low. Do we run the risk of having a significant increase in over-leveraged homeowners or distressed sales if rates continue to climb?
There's that possibility, and in any housing market, there are people just on the edge. There are times when you're making bets on housing, especially on the investor side of things, where people buy, perhaps they overbuy on the expectation that home prices will still be going up, and therefore you may not recoup on rentals, but maybe you recoup on the capital value later on. But that's not necessarily going to be happening anymore, or at least in the short term. We saw very, very strong housing price increases all the way up through February. And now with the higher rates, if anybody had been on a variable rate mortgage that perhaps they could not extend the term of the loan on, they're seeing possibilities of significantly higher monthly fees or interest charges for their lending or their borrowing.
And some have started to raise alarms, and maybe you can weigh in on this if maybe they're a little over the top. Some have said that this feels like the preconditions of 2008, where you would see a larger portion than we're comfortable with of folks be over-leveraged to the point where they have to sell. Are we there, or is that maybe a little too overzealous in terms of the concern?
Well, 2008 was more a U.S. phenomenon, where the number of borrowers that were subprime, which means that they were not as in a high kind of borrowing capability, were offered mortgages anyway through a very decentralized system of mortgage brokering and so on. Canada never suffered from that nearly as much because our mortgage system was far more instilled within the major financial institutions. And over time, over the past 10, 12, 15 years, we have seen an expansion in the sort of the private lending market that has perhaps caused some concern for people borrowing that way, because there's a lot less regulatory oversight, or the regulators have difficulty managing that kind of informal lending, which those are the groups that are likely going to have more of an issue with perhaps loans being called. Some have made bets, hoping that they could, ride out the market or make a lot of money there. Others were perhaps, unfortunately, caught up in this. People need a place to live. The only options available are houses that are overpriced now because of either a combination of government policy, low interest rates, and so on. So, it is a difficult situation for many people, but it's something that old timers have seen before. It's through the early 80s and early 90s were troublesome times in real estate in this country, and we're now getting back to this generation seeing difficulties really for the very first time. So they are probably going to have to people in the situation of much higher mortgage servicing costs are going to be having to make some adjustments in their spending on other items.
And we have about a minute before we go to break, but we'll start here in terms of business investment. Do you see this as being, with the rising interest rates, being a factor in terms of discouraging business and investment and some of that economic growth that is hoped for post-pandemic?
We've often had trouble with business investment, really, for the past 5 or 6 years, because the oil price crunch back in 2014, 2015 really changed the structure of the growth path for the Canadian economy. No longer was it going to be based on oil exploration, heavy oil development in Alberta, and the economy and the financing structure was geared around those kinds of elements. Canada has to find new ways to, develop its industrial capabilities. There are some opportunities out there, but it means businesses taking risks. And historically, that we've seen kind of a reluctance of businesses, or sort of a lack of opportunities to kind of replace that investment flow that had been there back in the mid-teens of this the millennium.
And we're back on Counterpoint. I am joined by Ted Mallett. Ted, before the break, you were just describing the dynamics of relying on, let's say, the oil and gas industry, and what this means for those opportunities moving forward. What are some of those opportunities, if not oil and gas? What drives economic growth in Canada?
Well, we are going to be seeing an energy rotation. So for the same reason that perhaps oil and gas is sort of lesser up there, but we're going to be moving towards battery technologies, changes in the automotive sector. There's been some major investments in the auto sector in central Canada that perhaps will lead to potentials for related companies and suppliers and so on in that area. So certainly the new ways of doing business. COVID taught us how the office works and how people can work far more remotely. So that's bringing changes and opportunities to the way that businesses can offer there. So change will always bring some potential new investment potentials for Canadian businesses, and our hope is that's going to be there. Our expectation is that business investment is going to grow reasonably well, above that of just before the pandemic. But there's still risks in that kind of forecast, and certainly higher rates is going to dampen that a little bit. But so far the movement, even though it looks large just in the space of 1 week, is relatively mild in the scheme of things.
And on that note, I mean, you talked about the prospects for growth. Do you see we had a previous guest talk about a recession, stating that it's not a question of if, but when. Do you feel that a recession is on the horizon, or do some of those growth prospects give you reason to be optimistic?
I think the notion is that it's probably a 50-50 proposition, but remember, a recession or not recession is not a binary or a yes/no kind of question, because you can have very slow growth for a number of years and end up at a worse point than if you have a short, sharp recession and then reasonably good growth after that. So the hope is that if there's a bit of a resetting phase that the economy has to go through, and we've long forecast that kind of thing. It's just happening a little faster than we had expected earlier on. It's the kind of reset that's really required, and getting the housing market back into reasonable territory where it's more affordable, or prices are kept in check. The inflation expectations of housing has to be kept level, and then also bring down the inflationary expectations of the general public, so that we can get back to the 2% bound that the bank has traditionally rested on. That should set up the economy much better in the longer term.
So, I mean, when you talk about the economy in the longer term, I want to just ask you a question about, over the period of the pandemic, the Canadian Federation for Independent Businesses had regularly reported that many small businesses took on a considerable amount of debt. How hard is this rate increase going to hit those independent businesses, those local stores who maybe took on a lot of debt to survive at low interest rates? Is there a prospect of foreclosure in those instances, or are they still going to be able to dig out of that hole?
It's a good question. A lot of small firms were having to go into debt in traditional sort of lending vehicles. There was also the government-sponsored lending program, that the business account program that allowed them to get a certain amount of money. I believe it was $60,000 in loans, and some of that was forgivable. So, there has been some benefit along those lines. In that particular loan, I believe interest rates are capped until a period of time, through the end of next year, I believe, or the year after that. So there is some protection on the businesses that took part in these particular programs, but those who borrowed beyond that, perhaps they had to retool, they had to change their business processes and so on. If it was done outside that particular government program, yes, they would be facing higher interest rates for that lending. So, the expectation, though, is that we've seen so far relatively mild bankruptcy numbers coming out, and the other is that the number of businesses, according to StatCan, that are operating is more or less back to the pre-pandemic levels. So, there are, now that could be that there are a lot of brand new businesses that have reset according to the sort of the new economic conditions, and that others have fallen by the wayside.
And we're back on Counterpoint. I am joined by Ted Mallett of the Conference Board of Canada. We were just chatting about business recovery and bankruptcies in business. Another issue I really wanted to dive into here is the cost of government debt, because for a long time, Finance Minister Freeland had justified spending decisions and saying that they were capitalizing on low interest rates. How impacted is, let's say, the federal government's debt servicing with rising interest rates, or are they protected from that?
Well, usually when the government decides to borrow money, they borrow it on a fixed term, whether it's medium or long-term bonds. They could be 5, 10, 15, 30 years, for example. So they negotiate that when they borrow the money. So for these longer bond periods, for example, they're pretty well locked in. So the immediate changes in the interest rates will not really affect them. It'll only be affected when they have to renegotiate those or turn over those particular bond purchases. So it's only necessarily when there's new debt to come in. If they want to borrow more money for various programs and so on, they will be facing higher rates for borrowing. But at the same time, we're seeing high inflation, which means that the nominal value of tax revenues and so on are going up very quickly. And in many respects, government deficits have come down very quickly because of price pressures. That inflation is kind of eating away at the real value of debt.
And so the way in which you're describing this is essentially the recent rate hikes are more a factor in terms of tomorrow's decisions in regards to spending and borrowing, and less so the government facing a bigger bill on debt servicing because of those fixed agreements, correct?
Yes, that's right. Not to say that borrowing all the time is always the best thing to do. You have to look at the long-term rate structure and what the economy is capable of producing, and that any kind of borrowing is actually borrowing from or passing on the costs of something onto future generations. And we don't like to see that done unless it's really necessary. So diminution of the debt relative to GDP or incomes is a notable goal that government should be pursuing, and simply keeping it at relatively high levels. And Canada does have high levels of debt to GDP or debt per capita compared to other countries in the world. Now's a good time to deal with that.
And in regards to the growth side of that equation, because obviously you want the economy to continue to grow, what are some of the key factors at play here that determine Canada's competitiveness or growth prospects over the medium term?
Well, you want to take a look at businesses willing to invest, what their expectations are for business planning and so on. Therefore, the confidence indices that the Conference Board develops and uses are important predictors of that sort of thing. There has to be a sense that if a business does decide to invest, it's relatively easy to do so. The regulatory path sometimes is problematic. Fraught with pitfalls and delays, and that really cuts back on the ability or the interest of businesses to go out there on a flyer, because any kind of investment is a bit of a risk or a gamble. They're hoping that they get decent returns on that kind of investment, and that those returns may take a number of years to come to fruition. So there has to be a great deal of trust that in governments that businesses that are wanting to or that they can decide to make these kind of investments, because that's really what determines the growth of the economy tomorrow and the years afterwards.
Yeah, that's a very, very good point. The regulatory burden that businesses face, whether we're talking about housing developers or the industries that are extracting minerals for the electric vehicle revolution, all of that really does depend on the hurdles that they have to jump through in the process of finally bringing those goods and services to market. Ted, it's been a pleasure to have you on Counterpoint. Thank you very much for making the time.
You're very welcome. It was a pleasure. Thanks.
Well, we've just unpacked the Bank of Canada's rate hike. Is the doom and gloom projection of economic catastrophe accurate? I think the jury is still out, and so only time will tell.